Have you ever heard of private equity and venture capital? Did you know that many billionaires do not limit themselves to investing in stocks or real estate, but rely on these strategies to multiply their wealth? Traditional investments like the stock market can offer attractive returns, but the world's richest want more. That's why they enter the exclusive world of private equity and venture capital, where the earning potential is much higher. In this video, you will discover what these two forms of investment are, how they work, and why billionaires prefer them to grow their wealth exponentially. Private equity is a type of investment where large investors buy shares of private companies to improve their performance and then sell them at a higher value. This sector is only accessible to investors with significant capital, such as pension funds, family offices, and ultra-wealthy individuals. How private equity works. Business acquisition. A private equity fund raises capital from wealthy investors and uses this money to buy private companies or take control of existing companies. Business optimization. Once acquired, the company is restructured and improved to increase profitability. This may include cutting costs, expanding into new markets, and streamlining management. Sale at a profit. After a few years, the company is sold, often at a huge profit. A sale can be through a spin-off to another company, a sale to other investors, or an IPO. Why do billionaires invest in private equity? Private equity offers much higher returns than traditional investments, with earnings that can exceed 20 to 30% per year. Unlike public stocks, where investors are spectators, in private equity, billionaires have an active role in the management of companies. Because companies are not publicly traded, investors are not subject to stock market fluctuations. A famous example is that of Blackstone, one of the largest private equity funds in the world, which has transformed struggling companies into highly successful enterprises, generating billions in profits for its investors. While private equity invests in existing companies, venture capital focuses on high-potential startups. It is a form of financing aimed at young, innovative companies, often in the technology sector, with the aim of transforming them into global giants. How venture capital works. 1. Identifying the most promising startups. Venture capitalists look for emerging companies with innovative ideas and huge growth potential. 2. Equity financing. Investors provide capital to startups in exchange for a share of the company. 3. Growth and scalability. The capital received helps the startup to develop the product, expand, and scale the business quickly. After a few years, the investor can sell his stake through an acquisition by a large company or through an IPO. Investing in a successful startup can generate incredible returns. Just think of those who invested in companies like Uber, Airbnb, or Tesla in their early years. There are opportunities for stratospheric returns here. Exclusive access to new opportunities. Venture capital allows billionaires to be first in on game-changing companies before they go public. Portfolio diversification. Although the risk is high, by spreading your investments across multiple startups, your chances of achieving great success increase. Jeff Bezos, for example, invested in Google when it was still a small startup. That single investment turned into billions of dollars in earnings. While private equity and venture capital may seem similar, there are actually some key differences. Private equity focuses on established companies that have a working business model and are generating profits. Investors' goal is to acquire these companies, improve their management, and increase their value before reselling them at a significant profit. Venture capital, on the other hand, focuses on emerging startups, often in the early stages, that have an innovative idea but still little financial stability. These investments are much riskier, but also offer the possibility of huge returns if the startup becomes a giant in the sector. Another major difference is the level of control. In private equity, investors directly take control of the company and guide its operations to improve its performance. In venture capital, on the other hand, investors provide capital and strategic support, but do not necessarily have an active role in the day-to-day management of the company. Risk also varies between the two strategies. Private equity, while moderately risky, focuses on companies with a solid track record, making it a safer investment than venture capital. The latter, investing in startups that are not yet tested on the market, has a much higher level of risk, but if the company is successful, the returns can be extraordinary. For this reason, billionaires often balance their portfolio by investing in both strategies. On the one hand, with private equity, they obtain stability and constant returns. On the other, with venture capital, they aim for explosive growth opportunities. In addition to participating in private equity and venture capital funds, billionaires use other tactics to maximize their earnings. They create their own investment funds. Some billionaires, like Peter Thiel and Mark Andreessen, have founded venture capital funds to gain direct access to the best startups. They reinvest profits into new projects. After earning profits from a successful sale, they reinvest the capital into new opportunities. They use connections to get exclusive deals. The best investment opportunities are often only available to those with the right connections in the business world. A perfect example is Elon Musk, who used the profits from the sale of PayPal to invest in Tesla, SpaceX, and other innovative companies. Today, he is among the richest people in the world thanks to this strategy. While private equity and venture capital are primarily accessible to wealthy investors, there are ways to leverage these strategies, even with smaller amounts of capital. To invest in listed private equity funds, some funds offer shares accessible to retail investors. Participate in startup crowdfunding platforms. Sites like AngelList allow you to invest in startups with small amounts of capital. Learn to evaluate innovative companies. Studying the world of startups and private companies can help you identify growing investment opportunities. Private equity and venture capital are two of the most powerful tools that billionaires use to multiply their wealth. By investing in growing companies, optimizing exit strategies, and harnessing the power of private capital, they are able to achieve enormous returns and diversify their portfolios. Now that you know the secrets of these investments, which of these strategies are you most curious about? Have you ever thought about investing in startups or private companies? Write it in the comments. Subscribe to the channel to discover more investment strategies of billionaires.